Today is a very painful day for those of us who might be short the market. However, despite the price action, I can't let price dictate my sentiment. And when I look at the facts, my case is not able to change, unfortunately, as that might be, given the price action, given the strength in the market, and given how the strength has disproportionately impacted just a handful of stocks. And I want to lay out some facts and put into this into perspective. Both Apple and Microsoft are nearly at all-time highs. Microsoft is above where it was at certain days during October of 2021. That was just before the peak in the market, completely different environment, before the Fed even began talking about hiking interest rates. And since then, in the October 2021 quarter, Microsoft earned X. In the October 2022 quarter, so Q4 2021 versus Q4 2022, Microsoft's earnings, Microsoft's net income declined by over 12%. Apple, higher than it was right now, it's higher than it was in November 2021, just before the Fed began talking about increasing its interest rates. Its net income is down over 13% since Q4 2021, Q4 2022. That is big because in those Q4 2021s, earnings was declining, and it was projected that earnings would continue declining in 2022. That did not occur. It was also projected that interest rates, the Fed would hike less than 1% in 2022 at that time. We all know how that panned out. It was also projected that inflation would fall dramatically. Now, the stocks are above the levels of those times, and these are the stocks that have had the most gains. Before today, and it's probably even more extreme today, Microsoft, Apple, and Nvidia accounted for 91% of the S&P 500's gain year to date. That's quite an impressive statistic and shows you how concentrated this move is in just a handful of stocks. I think it's gotten quite extreme, but these are just numbers. These are just individual stocks. This is just earnings based on what's happened and whatnot. Let's get into the actionable stuff that's going in right now. The market is currently priced going forward to finish the year at a 1.7% chance. 1.7% chance the Fed does what it says it's going to do and has affirmed as recently as today that it's going to do. Now, the saying is don't fight the Fed. That is probably the number one piece of advice I have heard from market veterans like Carl Icahn. Carl Icahn says his number one piece of advice is don't fight the Fed. He's bearish. Legendary investor. There's a track stadium in New York City named after him. Legendary guy. The Fed is reaffirming today they anticipate to hike one more time. They're saying they don't see progress on inflation in core services ex housing. That is the most important area of inflation. It's not coming down. And you can see that for yourself in the data. Look at core PCE. It's not coming down. We just had the highest month-on-month read in over a year. Tied for the highest. That was the January read. We're getting the February read tomorrow. I get it. It's late. But guess what? We're getting some March inflation data. And it's not showing any signs of softening. It's not, at least not in Europe. Yeah, you can look at CPI, but we know that you're not supposed to look at CPI. The Fed doesn't want to look at CPI. They want to look at core inflation, excluding food and energy, because food and energy are particularly volatile categories of inflation. So, excluding food and energy. So Europe's CPI read, you look at the Spain CPI, yes, it fell, but look at their natural gas prices. Natural gas went from $350 a unit to $40 a unit, so CPI is going to come down. Unlike in this country, in Europe, in Spain in particular, core inflation is well above CPI. As a matter of fact, it was actually in March, preliminary data, a record difference in the positive direction between CPI and core CPI. So core inflation, quite hot, quite sticky. Yesterday, the ECB was calling it out by name. Core inflation, quite hot, quite sticky. And it's hot. The data is hot. So the data is hot. The Fed is tightening. The market is mispriced in the rate picture. Look at yields. They're down a lot in the past couple weeks. The Fed is trying to hike to get yields to go up. Yes, there's this effect that, banks might get concerned about lending and whatnot. We'll see if that has an effect. It's possible it might. But so far in March, it didn't have an impact in Europe. We'll see if it has an impact in the United States. But their inflation is still hot. Germany, despite the decline in their CPI, it was still 0.8% month on month. That is 9.6% annualized. That's a high read. I don't know what their core inflation was. German core inflation month on month. Let's see if we can pull this up real quick. Let's see, month on month, March preliminary. Because if this is high, I don't know if we can get this. Still high. 5.9% overall versus the 2% target. I mean, we're not ending the inflation battle yet. The Fed is going to err on the side of over-tightening. And I think it's been like weird things like the banking crisis that have progressively moved the bulls to like forget the previous thing and focus just on like some new thing. But those things are still out there. Like the dot plot moved in the hawkish direction. Inflation reaccelerated, core inflation reaccelerated now 3 months in a row for PCE, 4 months in a row for core CPI. These are not good statistics. This is like the stuff that matters. So we're at a point now where the biggest stocks in the S&P 500 are near their all-time high, but their earnings are declining, interest rates are much higher, their multiples are well above their historical multiples, and they're well above the S&P 500 multiples, but their earnings are declining at a faster rate than the S&P 500. So I'm just trying to talk about the facts. I'm not making anything up here. None of this, I'm not even really speculating. If anybody is speculating, it's the market speculating on the Fed and anticipating rate cuts this year. So I'm not trying to speculate. I'm trying to go with what I see, what is being put in front of me, what the facts are. And I'm sorry, I'm genuinely sorry if that has led you astray and caused you financial pain. Please know that it has caused me financial pain. I haven't lost any clients yet, but I'm not going to be surprised if they leave me if this continues to go on. It's gotten extreme. I run a performance-based business, and I haven't been performing. And I owe it to you to not only acknowledge that, but if I'm going to make these videos and try and talk with authority, to perform well. And I'm thoroughly disappointed in my performance thus far year to date. I'm not happy. I'm not winning from it, not benefiting from it. I'm just doing the best I can to do the best work I can at this desk every day for several hours every day, giving it my all with passion. This is the best I can come up with. I'm not trying to do anything delusional. I'm not trying to be delusional. I'm trying to share with you my best and genuine thoughts. And this is what I know. This is what I see. This is what I feel. This is what I think. And do with that what you will. I wish you all the best. That's today's video. Tomorrow we're getting PCE. And until then, peace out.